Is L Brands a brand for you? Today I want to talk to you about L Brands, which is the holding company for two widely known operating companies, mostly in the United States, but also around the world. One is the very well-known Victoria's Secret, famous for selling women's underwear, but also other products, mostly located in malls in the United States. The second is called Bath and Body Works. It's a scented candle shop, for lack of a better description, and it sells products for the home, it sells products for the bathroom, and it sells very high-end, slightly frivolous goods in the setting, again, of malls and airports. Why are we looking at the company today? We're looking at it because it's a household brand. It's got a market cap of $5 billion, and the stock has been in free fall for the last 2 or 3 years. Let's take a look. You can see here, you can buy the stock for about $16 a share, but that's way down from the high of 4 or 5 years ago. What's accounted for the collapse, almost collapse, of Victoria's Secret and of L Brands, the parent company? The reason is fashions have changed, and this is a fashion-driven brand. Women don't like sort of seeing models, skinny models on runways and think that applies to them. And they also don't like the prices of some of the Victoria's Secret products. They cost $40, $50, $60 for a bra or maybe some pajamas or whatever else they're buying. So it's a costly proposition, and it's driven by mall space. It is have an online presence, but most of their business is done in shops in malls, and that's a slightly yesterday proposition. The bad news on Victoria's Secret, on L Brands, the parent company, is well known. They've cut the dividend, sales have contracted, clients are looking elsewhere to other online retailers to buy their underwear, perhaps to buy their pajamas, swimsuits, whatever it is they're buying. The good news could be at $16 a share, you're buying a stock that may have a $30 to $40 valuation. It also has a yield, if they could keep the dividend, no guarantee there, of 7%. So if you knew this was the bottom, and as they say, don't try to catch a falling knife in stock markets, if you did know that this was the bottom, if you got 7% on your money, and if you got a restabilized L Brands, Bath and Body Works has performed well, much better than has Victoria's Secret. You could be buying a company that pays you a nice yield over time and approaches its $40 valuation in a fair market sense. What's the challenge of L Brands? The challenge of L Brands is simply, if they've made money selling $60 bras and $80 pairs of pajamas, to suddenly be a discounter or to try to compete with an online presence and some of their very cheaply priced products, that's a risk. The second risk, I think, with L Brands is simply that they have a lot of bricks and mortar around the United States, probably around the world. They're in malls, mall traffic is down, online is up. The margin is better online, but you can't just walk away from 1,000, 1,200 stores. I would not be buying L Brands even at $16 a share. Why? Because I don't like companies that haven't turned themselves around that. I also think turnarounds are a very hard proposition. It's tempting. 7% would be a lovely yield in today's market. And if the company, which is known universally, certainly around the United States, certainly by a lot of shoppers who go into malls every day, there is the chance that this is a recognizable brand. There's also a chance that some other retailer might come in and take them over. I don't dream, though, with my investments. I try to be realistic. I think it's still at $16. It's probably overpriced. I don't like you, the investor, investing in something that isn't proven that it's growing quarter to quarter. That's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.